Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. One of the most common conversations we have with investors starts something like, the lender will give me 75% LTV. But 75% sounds simple until you ask the obvious question, 75% of what? Purchase price, current value, end value, market value, investment value, day one value, or gross development value. In this episode, we're going to demystify valuations, explain how lenders actually look at security, and why understanding valuation methodology can completely change the viability of a deal. Let's dive into it. Mark, welcome back. How are you?
I'm very well. Very well. How are you?
Yeah, good. It's been a busy few days out and about on the road at various networking events and whatnot. So it's been lots of good conversations with different people in the market, lenders, the brokers and different, service providers within the industry. So it's been a busy few days. Lots of trains and buses and various things which I'm not particularly used to, which, maybe that's a conversation for another day.
Planes, trains and automobiles, eh? So
something like that.
No, so I forgot actually, I didn't forget. We were at the FRA, the Financial Reporter Awards, up for Short-Term Broker of the Year. Didn't win, but nice to get shortlisted in the first place and go and catch up with some people at the awards.
Absolutely. It's good to be nominated by a lender on that basis, which is a kind of different setup to most awards. So, yeah, well done. And you and the team on getting nominated in the first place, like you said, and making it to the final. So, I'm sure it was a good day. I couldn't make it, but I'm sure you had a good laugh anyway.
Yeah, no, it was all right. It was good. It's good fun. Good fun. Award season's coming to the end now, so it's good.
So what are we thinking today? We're talking about valuations, which seems to be a kind of high topic of conversation for us on this podcast and just generally in the market. This is born out of some frustration, obviously. What are the frustrations at the moment?
Yeah, so the reason I thought this would be a good topic to pick on today is, we do valuations, and I don't think there's ever going to be overkill on valuations because this is a bit of a moving feast. With it. So what we're finding at the moment is I've written down 75% of what exactly are we looking to lend against. And we'll cover off in this episode the context around what that number actually is, because it changes the viability of transactions. So what we're seeing is not so much the value, values are not necessarily meeting expectation. So they're not down valuations, they just aren't stacking up against what people believe the values to be. And to top that off, then if a lender says we'll do 75%, but it's of a different number, and that number's lower than what you were expecting, then you're being hit twice. We've got one case at the moment where actually the number's been reduced so much it no longer works. So we're now having to go back out to different lenders to understand the context of their 75% to see, because if you do it on open market value, we'll come into this in a sec. If you do it on an open market value or indeed the 90-day value, the numbers are pretty different. And it is fundamental to whether that deal works or not.
Yeah, absolutely. So let's just kind of break down the myth, so the understanding, the majority of people who deal in property will say a property worth 200,000, for an example, 75% of that equals a loan of 150,000. Pretty straightforward. The reality is that different lenders may produce different valuations, different lending figures, and different outcomes based on those valuations. And that's on the exact same property. And so ultimately, lenders don't lend against your opinion of value. They lend against their opinion of value, which ultimately is the most important. We can argue with them till the cows come home. We often have clients wanting to appeal. And I think in my what is it? I don't know what it is. And I keep losing track. 15 years of maybe even 16 years of being a broker. I think I've only ever won 2 appeals. One of those was because there was a material error on the actual valuation. So if you take that one out, I think we've won 1 appeal. And so they just don't, and some lenders got to the point where they just say, there isn't an appeal process. You can't appeal it because we don't believe that we've taken that person. So unless you can, again, materially say that this is a mistake that they have left out, there's a material mistake in there compared to an opinion, then those are two very different things. And we get it all the time. But we have to move on, that ultimately, and it's a challenge. And I guess one of the frustrations for us is that we get sometimes caught up with as if it's us that have valued the property and not somebody else, and we get chastised a little bit for it when things don't come back in clients' favor. But that's the nature of dealing with clients and what we do, isn't it? That's we have to manage that.
Yeah, and on that point. So the point is that you won't actually know any of this stuff until the valuation report comes back in. So everything is done on an assumptive basis to begin with. When we ask what's the property worth, it's my assumption it's worth this amount. You have to have informed, educated guesses, for a better word. When the valuation report comes back in, that number may still be supported. So it may still value at 200,000 and you thought it was 200,000. However, there may be something else in that valuation report which says no, that the lender isn't prepared to do 75%. 70, and they'll say 70% because perhaps, I don't know, there's a pub 3 doors up or something along that lines. And therein lies the difficult bit. You try to second guess and you try to, as much as possible, preempt any issues that may find themselves to affect the value. But in reality, you're not the valuer. We don't know the location. We aren't out there physically inspecting properties to make sure what the client says is correct. And until a report comes back, you never truly know. And the underwriter might decide actually there's a risk they're not prepared to take, or they will take, but they won't do it at that particular level. So, we do get scenarios of that, and it can be quite difficult to try and stop that from presenting itself.
Yeah, absolutely. Okay, so let's talk a little bit about the different types of valuations that do exist. So the most common definition is, what will this property sell for today? And that's the type of property. So is it a residential home that someone that you and I are going to live in? Is it for a buy-to-let, for a tenant to live in? Or is it more of a commercial transaction? And when we say commercial transaction, we're not necessarily talking about commercial property here. We're more talking about, is it an investor market? So for instance, let's just use a multi-unit block. So there may be 10 studio apartments in a block of flats. They are all about 20 square meters in size. So nobody would buy them as a residential because they would just be too small and you wouldn't be able to get a mortgage on them. So really, it's only an investor that's going to buy the block as an investment only. So it's investor stock as a commercial transaction, a business transaction. So then you've got the purchase price, and then the majority of lenders will use purchase price, the lower of the purchase price or the valuation. Do you want to just talk a little bit about that?
Yeah, so that's an important distinction, and the key here is the lower of, obviously. So what you're paying for it versus what it's worth. If the value comes in lower, then the lender's going to side with the valuer, because its market value is the perception here is that you're overpaying, and the lender will only leverage against what the market value is deemed to be. If, on the other hand, you are buying it at 100,000, the valuation comes back at 120 market value, then it's deemed the value is what you're paying for it. So therefore, the overriding factor will be the 100,000 that you're actually buying it for, not the 120 on the valuation report. The valuation report will ultimately give you comfort that you're not overpaying for the property. In fact, it'll probably reinforce the fact you're getting a good deal. Nonetheless, the lender will only pick on the lower of the two. And these are the real thing here is that the purchase price is a very good barometer to what the property is actually worth. If you're paying 100,000 for it, then do you know what? It's worth £100,000. Otherwise, you'd be paying 120, and so on and so forth. So sometimes we can get drawn into that conversation. It's worth noting the ultimate thing here is if the valuation comes back lower than what the purchase price is, you've now got a tool to go back and possibly renegotiate on the purchase price. What your homework or your due diligence before you made the offer, there's support and evidence to contradict that, which then gives you the ammunition to decide, right, I either pay the difference because I can see past that and I can see it's worth this and what have you, or alternatively, I'll go back to the vendor and renegotiate on the purchase price with my evidence now to promote and support that it's not worth what I'm paying for it.
Yeah, and I guess this is where we have to throw, so that the majority of the transactions that we deal with will be in this format, and that's 99+% of transactions. And there are some opportunities where we can have lenders who will, so if you are having people will say, well, I'm having a discount. Fine, you are having a discount. But if the property's been on the market for 12 months and you're not buying, you're having a 10 grand discount, like you said, then that's not a discount. Now, if the property, so let's say the property's on the market for 200,000 and you've agreed 180, then you're not, the value is 180. Whereas if it got to the point, and if you had somebody, let's say that property was at auction maybe, and it was a repossession, or there may be some other reason why they just needed somebody as a circumstance that they needed to sell a property quickly and they just got to get rid of it. They might be moving out to the country and they just want it sold because they're emigrating, for instance, and they're not bothered about what they get for it. They don't need the money, and it's on the market, the 200 grand, but they'll take 100. That is BMV. That is under the market value, and no matter which way you look at it. And there will be some lenders that will lend against then the value and not the actual purchase price. But those aren't going to be mortgage companies. Those are going to be bridging lenders, and they will want to understand a little bit more about it. But they would also restrict potentially that to maybe 90 or 85% of the purchase price. So they're still not necessarily going to give you 100% lending, but they want to see some skin in the game from you. But those are a very small number of transactions that we would see, is that right?
Yeah, definitely. It is a ploy out there, and the main part is the distinction between bridging and mortgages. You're not going to get that solution. There is one or two lenders that will consider doing BMV mortgages, which is up to 90% of the purchase price, as long as it doesn't exceed 75% of the actual market value. And that speaks to what we've said is 75% of what, so 90% of purchase up to 75% of the open market value. You can go in certain circumstances to that. If you want 100% then of the purchase price, it is ultimately going to be a bridge lender. And even then, there's very few of those. And even then, those that do it have a very specific set of circumstances they need to apply in order for them to consider doing that 100%.
Yeah, and ultimately, exactly. So just because you buy in a property well, you're doing it doesn't mean that the lender will fund the uplift in what you're getting, isn't it? Or they'll fund that discount. So, yeah, just be mindful of that.
There's a perception when we speak to a lot of clients, this is particularly in the BRR space, by refurbished refinance, who perhaps don't have the capital they need for a project. They're going to find a great deal, which is, it's going to be worth 300,000 when it's done. I'm buying it for 100. I want 50,000. 50,000 works. Can I borrow against the end value? Theoretically, yes. But there are also limiting factors in that. And we'll come on to that in a second around the percentage. So the percentage of 75% loan to value against the end value, absolutely, that works all day long. And that looks like you end up putting no money in the deal at all to begin with. And the lender 100% funds it. It's just, it doesn't work that way. And there will always be a limiting factor, meaning that you will need to put some capital in of some description. The question is, how much do I need to put in? And that's where we come in then, finding the right lender for the deal that you've got on the table. But you will always need to put something in.
Yeah. Okay. So let's just talk quickly about the difference in different valuation. We're going to talk a bit about development finance in a second. But let's just, before we do that, let's talk about the different valuation methodology. And I know you've covered this in previous episodes, but the difference between the market valuation, 180-day valuation, and a 90-day valuation.
Yeah, so the question is slightly different. So those three things are, so the open market value is the valuation of the property, assuming that it could sit on the market forever and ultimately have its buyer. So there's no time constraint on it. So that's the open market value. The second point then is the 180-day value. So that's 6 months. So it's a time restrained constraint that's applied to that logic. So if I only had 6 months to sell it, if I had to sell in 6 months, what would I need to market it at to sell it in 6 months? And then 90 days is 3 months. And then the question is, if I had to sell it in 3 months, how much would I have to market it for in order for it to be sold in 3 months? Those numbers are different. The open market value, you probably usually will see around about a 10, maybe 15% drop between the 180-day value and the open market value. Similar number change between the 180 and the 90-day. Sometimes you will see it jump massively. The main reason you'll see valuations where the 90-day is significantly different is where there is a lack of demand for that type of property. So it could be something that's quite niche. It could be a flat above a Chinese shop, type thing, which is going to have a restricted market. It could be a commercial property that's specific, like, I don't know, a lab of some description. There's only certain people who can go and occupy that property. Therefore, it's going to diminish in its value if you restrict that time window shorter and shorter. So that's the difference between those three things.
And it is important to distinguish those because people may not know about those that well, and it's important to understand what a lender will lend against on which one of those values, because some lenders will lend against the market value, but some will lend against the 180 and some will only lend against the 90. So you need to, when you talk about 75% of what, are they lending 75% of the market value, 75% of the 180 or the 90? So as you said, those end numbers on what you would actually get can massively change depending on which one of those figures they use.
Absolutely. And the other one that we've got there is, so the lender might say we do lend on open market value, and that is true. However, when the valuation report comes back and either the 180-day value or the 90-day value is lower than they would like, or the difference between those numbers is too great, that would imply that there is a nuance within the valuation because of the time-bound restriction reduces that value too much. And then they will, at underwriting, default back to, actually, we're not comfortable with this now because the differences will now revert to one of the lower numbers. So this is where it comes back to 75% of what you started on the open market value. The valuation report has come back in. There is a difference between these two numbers, which a lender is not comfortable with, and they will revert to either reducing the loan to value on the open market, or usually what they'll do is they'll keep the same loan to value, 75%, but put on the lower number instead, which has the impact of effectively reducing the LTV on the open market value.
And it's a really frustrating get out of jail card from the lender's perspective, very frustrating for clients and for us as advisors. Do we agree with it? Of course we don't. But ultimately, it's the lender's money. And they are the ones lending it. It's up to them what they want to do and how they want to operate. And it's frustrating. But if you don't have too many other choices, then the lender is able to do that, aren't they? That's the key piece on it.
And this doesn't happen that often. Okay, so it's not. I don't want listeners to be thinking, "Oh crap, I'm now going to go out and I'm going to have all these problems." It doesn't happen in the more vanilla spaces. So the straightforward buy-to-lets tend not to have this happen to them. Where we tend to see this appear is where you're now working in a more specialist environment. So there's a quirk, the property's a bit unique, your circumstances are a bit different. We're having to go to a lender that wants a blank sheet of paper and is, commercial in their thinking, and that's wonderful. but then the guidelines obviously start to blur a bit, and then you are at the mercy of what their perception is. When you go to a normal, I say normal, when you go to a more vanilla lender like a TMW, it's very prescribed. This is the value, this is a yes or no, and there's your offer, and then you pay the rate as such. Yes, you can get more creative with your deals, but that means dealing with lenders that are more commercial. And more commercial means this is all going to form part of that commercial decision. And you have to be prepared that things aren't necessarily going to go the way you intended. But they're there, they have a purpose. They can be particularly good in certain circumstances, but this is very much a frustration that we sort of bang our head against a wall with it sometimes.
Absolutely. Okay, let's move on then. Let's talk about development finance and where the valuations or LTVs and what they mean within that. So do you want to just run through these, or shall I kind of throw them at you and you kind of discuss them? How do you want to approach it?
Well, if you like, I'll just cover off the different ratios that exist in development finance, or refurb finance, development finance, same thing really. There are three ratios that we use within development finance. We've got the day one loan to value. Okay, so what is the property worth today in its current state? And they will lend a percentage against that value. We've got loan to GDV. So what percentage of the end value will the lender be prepared to lend? I'll come on to the third one in a second. A lot of people, because the lender will say, we'll do 65% loan to GDV, let's say, okay, which is a very common loan to GDV in the space. Let's assume the property is worth 100,000. 65% loan to GDV is going to be a 65 grand loan. So if you're buying it for 30 grand and you're going to spend 45 on it, if you're buying it for 30,000, you're going to spend 15 on it, and the total project is 45,000. Happy days, I don't need to put any money in because the lender's going to lend 65% of the end value at 65 grand. So it's 100% funded, obviously. That's not actually the case. So the reason being, there's another ratio, the third one, the all important one, which is something called loan to cost ratio. The lender will lend 80% very often. So 80, 85 and 90% are the more common loan to cost ratios. That is really simple. The purchase price or the property value plus the build costs or refurb costs added together. So what's the project cost? And they will advance 80% of that. Now that number is normally limiting. So if we use the example I just used they'll do 65,000 based on the GDV. Well, actually, no, the project was 30 plus 15, which is 45, and they'll do 80% of that. So that's less 9 grand, which is 36,000 they will lend in that particular scenario. So you need to put 9 grand into it. So you can all of a sudden see now how, hang on, I was getting 65% loan to GDV on this. That's what you promoted. No, because the loan to cost ratio is limiting it, meaning that you actually will only lend you 36 on the project in that scenario. So it comes back down to 65% of what loan to cost ratio, 80% of what exactly, because when you go into development finance in particular, there are allowable costs that go into that as well. So certain professional fees are allowed, others aren't, still payments aren't, and all of that sort of stuff. So again, what is actually being included in that number to make up what makes it fall into that ratio? So there's a lot of nuance in there, and a lot of people speak to us thinking they've got a wonderful deal, which they have, and that they can just 100% fund it all. And obviously, if it was that easy, there'd be a queue in front of these lenders with my bowl saying, "Please, sir, can I have some more?"
Yeah, absolutely. Okay, so we've looked at the day one val, the GDV, what's the the scheme worth right at the end, and then the loan to the GDV, and we've done loan to cost. Is there any other sort of metrics used?
In order for the assessment of that, there's also important to note as well, there are some lenders, not that many, but there are some lenders that do not have a loan to cost ratio in their thinking. They will lend against the actual GDV. Okay, so don't think that this is an absolute no, but that's a very small percentage of numbers, and they have a unique set of circumstances that have to apply in order for us to be able to leverage against that. The other thing to bear in mind in this scenario is these numbers are always gross. So we've spoken before about bridging and development finances. In most scenarios, the interest is retained, in which case you're actually not getting 80%. You're getting close to the 65, 68% when you deduct all the interest and costs and what have you. So again, when you do that, actually the net loan to value is the important number over and above the gross figure.
And the key impact of this is, and you will have seen this numbers and countless times over the years, is that the biggest impact this has on clients is when they get the final terms. I don't know the answer, but you'll tell me this now. Almost every single time the client will go, I didn't realize I needed to input that much cash into this deal. Is that right?
Absolutely. I spend a lot of time with people trying to probably over-describe, especially refurb and development, because there's this assumptive side to it that I'm just going to get all this money. And people massively underestimate just how much capital it requires. So what they forget is that, the drawdown facility, the refurb side of things, is done on a drawdown basis. So it comes in tranches. They don't just give you all the money and let you get on with it. They give you a proportion and you draw it down in stages. But you have to spend the money yourself to get you to the first drawdown. So you need cash flow, you need operating capital in the cycle in order to move on. So in addition to the deposit and the stamp duty and the legal fees and all of the various bits and pieces, you need the extra bit of money to get you through the cycle. Now, you can obviously leverage your contractor. They'll do X amount of works. You've got accounts you can open with suppliers and run it on that. So you don't need all of the money, and there's other ways to do it. But people underestimate just how much cash is needed. And then when it comes back and says, yeah, we'll do it, and this is the evidence of funds that we need, and like, I'm 20 grand short, then you've spent 4 grand in valuation and QS fees or whatever, and now you've learned that you can't actually complete the transaction.
Yeah. Okay. So ultimately, a lender's perspective on this from a development aspect is they value the asset today as is. They will take into account all of the works that you are proposing, and then they will take that cost into account and value that as a proportion, what you've paid on the total cost, and then they will pit that against the end value. And the reason they cap it at 65% in the main is that there's enough for you to make a profit, and there's also enough wriggle room that if the market turns or if the project goes on for too long and they've got to pay the interest back, that you've got enough room in there that they're still going to break even, or you're going to break even and be able to get out of the deal. Because ultimately a lender's job is to lend money. They want that. The way they make their money is they recycle that as quickly as possible. So leaving their money in deals for longer than they'd initially agreed is not good business for them. But and this is sometimes a misconception. They want to lend money. They want to lend money, but they want to get it out as quickly as they can, and they want to get it back in as quickly as they can so they can lend it again. That's the velocity for them is where they make the money.
Yeah, definitely. And I think, again, I've covered this on previous ones as well. So they make a margin. It's not like, so they're paying for the money. So there's a cost of funds to come into them. They lend it out at a margin. Now, you might be going, this 1% a month, that's 12% per annum. They're making a killing. Well, they might be paying 10% for the money. So, their margin is the 2% or figures of that nature. If a deal goes bad, and then they have to repossess and what have you, and they can't recover all of that capital, when you lend another 2% margin, you have to put 3 times, 4 times as much money back out into deals just to make that capital back. So they will be lending for free, in effect, on the next 3 or 4 deals to recover the loss they made on the other one. So this is why lenders are very keen to make sure they understand the exit strategy. Bridging is a bit more relaxed than a normal mortgage, and there can be more solutions out there. But ultimately, they want their money back. They want to lend on sound lending decisions, good people, good experience. And that's why your presentation to the lender is key on it going forward. Yeah.
So, the headline for this episode really is 75% of what? And just to put it into context, within the different sections in buy-to-let space, that's 75% of the market value. So that is what or the purchase price, like we discussed. In bridging, that could be 75% loan to value, or 70% of the value, or 75% of the purchase price. And then within development finance, you got 70% loan to GDV, 85% loan to cost, 65% GDV. So you can see all these different percentages and what they mean. And hopefully that's just given a bit of context as to, it's easy to get lost in all of this and misunderstand or misinterpret and things. So again, our job and the reason we're doing this podcast is just to try and help people understand the context behind all of these different numbers.
Absolutely. Right. So if you've got your own cash, if you're sitting on £1 million in the bank cash, you can look at a deal and you can go, it's 100 grand plus 20 means, and it's going to be worth 200. You can do it all day long and it's your own cash, doesn't matter. The difference is when you bring in a third party, i.e. a lender, then they have a set of criteria that needs to be adopted. And irrespective of what you think, they're going to obviously go with what the professionals are advising them, whether you agree or otherwise, off the back of it. If it's your own money, you can do with it what you will. When it's someone else's money, you have to play by their rules.
Yeah. And as part of that criteria, is a good point that you bring up, is when we're talking about lenders' rules and criteria, the valuation is just one piece of that jigsaw. And therefore, they've got all of these other pieces of the jigsaw that they need to put together. What is your experience and your ability to deliver on this project? What's the exit strategy and the strength of that exit? And is it just one exit, or is there a multiple range of various strategies to exit? Liquidity, income, debt. Is there any other debt on there, or do you have what's your debt in the background, and your risk profile, your A&L position, what type of asset is it, the marketability of that property. So there's so many various pieces within the valuation. And that's why you might, even on the face of it, have been agreed this, but actually when they look at you overall, they go, do you know what? And because a lot of it is their own money, they can be a bit more flexible. They say, well, we want to do the deal, but we're just going to reduce the loan to value by 5% because we think it's a bit riskier otherwise we don't want to lend. So
yeah, and I had a very similar conversation actually at the awards a couple of days back with a lender, with somebody pretty senior in the firm, and it came back to, so all of this can go out the window when you've got somebody who's got a £20 million portfolio, no debt on it, fully unencumbered, and then they come and knock on the door and go, I want to buy this commercial property for £1 million, but I want a 100% loan. They're going to go, yeah, you're all right, you can have that. Because they know that they're good for it in the back end. If something went wrong with that commercial, they've got loads of assets that they could leverage to pay back that loan and still only be less than 10% loan to value across their portfolio. So context to everything. So 70%, so they would have 100% funded that because they see him as a good client. But then the context is actually still only 10% exposure across his whole portfolio. So again, 70% of what, or 100% of what equates to 10% of everything. So worth knowing.
Okay. And so what are some of the key mistakes or common mistakes that you see with investors?
In terms of valuations, the biggest one that we have is obviously the over-assumption on its value. Everybody overvalues assets, undervalues liabilities. Yeah. So if you ask anybody who's got a house on a mortgage, and they'll guarantee they'll give you 20 grand more than it's worth. And when you ask how much your mortgage is, it'll be 10 grand less than they actually own.
They round it down.
Yeah. And when you get the statements and have a look and go, yeah, it's just the nature of the beast, isn't it? We all do it. It makes us all feel a little bit better. But yeah, so overvaluation of that is a key thing. So my advice there would just be as realistic as you can be. Do your research on your comparables. So every lender will look for supporting evidence for that number. Okay, so if you're saying it's worth 200, have a look, get your comparables, pull back together. Now, when we say comparables as well, make sure they're actually comparables. Make sure that they have the same floor size. So if it's not just as simple as comparing two 3-bed houses, one might be 3,000 square foot, the other one might be 1,000 square foot. So just have a look to see, are they actually directly comparable in terms of size and number of bedrooms? Have they got gardens, off-street parking, all of that sort of stuff? So make sure your comparables are actual comparables. We see it a lot where we just got a list of 2-bed, 3-bed houses, and they are all over, they're in different locations. So one is in a cheaper location, whereas the other one is in a more affluent area and commands a different price. So there are nuances within that. And that's probably the biggest thing we see actually, is where people want to contest the comparables that have been used because they don't agree. And very often the valuer will come back and say, well, actually, yeah, this is the most comparable because of X, Y, and Z. So that would be my advice, is just make sure your comparables are genuinely comparables.
Yeah, absolutely. And another mistake probably is not, as we've talked about, understanding the lender methodology around how they use those valuations. That's quite common. And that's no fault of the borrower at all. And that's just trying to help people understand it, isn't it?
Yeah, definitely. So the things that we see are people valuing their properties on a commercial investment basis or a yield basis, whereas the lender then lends or values on a vacant possession basis. Those can be two materially different numbers. And if you've done the deal off the back of you're going to get X on the exit, however, no lender is going to value it that way, then that's a mythical number.
Mm. And at one of the meetings I was at last week, there was a bit of chat around some of the lenders who have done a lot of investment valuations on HMOs becoming a little bit nervous on what some of the valuations. So we could see some of those being a little drawn back a little bit. I think some of them were a bit too spicy with what they accepted from an investment valuation versus a market valuation, and they may end up catching a bit of a cold. So I think that will definitely kind of draw back a little bit based on those conversations.
And look, those properties that truly merit that valuation methodology are safe, they're sound, they're sensible lending decisions. It's the margin ones. It's the one where you're trying to put a 5-bed house with no en suites and that sort of stuff and squeeze that into because it meets the criteria. It's always going to be those ones that the lender's going to be nervous of. And those are the ones that are going to be, there's more of those than there are sui generis 12-bed HMOs that they've been lent against. So I can see them tightening up the bottom end of that and moving it further into planning consensus sui generis only and all of that sort of stuff would probably make more sense because they probably sound to be valued as more of a commercial entity.
Yeah. The other one we see quite a bit of is assuming that all valuers agree. You may have had a valuation done by one valuer. You might have just paid someone to do a valuation up front before you do the project, and they've given you a certain number. And then when you've ended up doing the project 6 or 12 months down the line, and then, you've had a valuation done by a mortgage company and they're different. Well, they could have used the same evidence, but it could have come up with a different, because of where the market is, a little bit about their sentiment of where the market is. And this is where it gets a little bit subjective. And then it's a bit more difficult to quantify those valuations. But ultimately, the lender will go with the one that they've instructed for their purposes. And there's not much you can do about that, really.
No, so we're in certain scenarios, you can try and use the same valuer that did the valuation on the refurb finance or development finance. We'd encourage that wherever you can, because it's very hard for the valuer to come back with a different number unless there's been something material that's gone on either in the economy or in the local area to affect that figure. So it can give you more confidence that you'll end up at the same place. In theory, every valuer should come back with the same number. But as we know, it's a professional opinion based on the evidence that they can find. And you've got people in the process. They are people ultimately, and they will have ever so slightly different opinions on what that is. You shouldn't see it be hundreds of thousands out. We're talking nominal differences as opposed to materially different in values. So that, and the reason I bring that up is we've also had scenarios where the client wasn't too impressed with the refurb value, the GDV on the deal at the time, but gone with it anyway because they needed the deal to happen. And I've gone, we don't want to use that valuer now for the next, make sure we use a different valuer. We weren't happy with the valuation report. And the number comes out largely the same anyway. Changing valuers isn't necessarily going to get you a better outcome either. On the basis they should all come back with the same number. You might get, as I say, some discrepancies, but it shouldn't be materially different.
Yeah, absolutely. And I think one of the big things that, so from an investor, anyone listening to this, what's the key takeaway would probably be, instead of thinking about what's the maximum leverage I can get, can I get 75% out of this, for instance, how is the lender assessing the value. It's a slightly different play or understand, and, just understanding, the key pieces is what valuation basis, what are they using? What's the lender's methodology? What are the assumptions that surveyor is going to make? What's the exit if it's a bridge or development? What's the exit valuation? And what are the downside risks that I'm facing, depending on what that sort of assessment is by the lender. So it's just if you're asking a few different questions to really understand the position, so that you don't get caught with a cold. Really, that's the key piece.
Yeah, and stress test everything, and don't just stress test to say, I'm going to stress test interest rates. That's not. Yes, obviously interest rates, and you just keep going. But stress test the value. So what is the implication if I can only get 70%? What's the implication if I can only get 65, 55, etc., etc.? That gives you your fail point. Just keep going until the deal doesn't work anymore. Now, if it has to happen at 74% and less means it fails, your margin for error is tiny and you are really at risk of something not going your way. If, however, it stacks at 65%, you've got a 10% gap in there. Even if the valuation comes back 10% lower, bear in mind you're getting 75% of that difference, then it's highly likely to continue to work. So just stress test and understand where the failure point is. That gap will determine how much risk you're actually taking. And that's probably the bit you want to pay most attention to. Yes, the interest rate is important. Of course it is. Cost of funds. But that's the cost of doing business. If the deal works, you'll have a queue of lenders and you'll just pick the cheapest one. Concentrate on how you're going to get out of these things. And does it actually work at said level?
Awesome. Thanks, Mark. Appreciate it. Hopefully now we've given people enough context to, just some things to think about around the valuations. And anything else to finish off from your side?
No, just remember 75% of what. So just make sure whenever you're being told a loan to value, or you see it marketed or whatever, however you hear it, what is the question you should be asking. If you ask that, you're in a good place.
Awesome. Thanks for your time again, Mark. Appreciate it.
No worries. Catch you in a bit.
The next time you hear someone saying they're getting 75% finance, remember that the percentage itself only tells a part of the story. Because in property finance, the real question isn't how much a lender will lend, it's what they're lending against and how they've arrived at that figure. And whether you're buying a buy-to-let, funding a bridge, or developing a site, understanding valuations can often be the difference between a deal that works and one that doesn't. Thanks for listening, and we'll see you on the next episode. Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.